Hi everybody, I'm Joe Garner, Director of Research at Emerald, and I'm joined here today by
Steve Russell, Co-Portfolio Manager for the Banking and Financial Services Fund.
Thank you, Steve, and you're joining us today for our very first edition of Small Talk, where we will be here interviewing members of our research team and talking about the insights and observations that they bring to us from the field and sharing them with you, our viewing audience. And we like to think small talk. It's where the ideas are big, but the market caps are small. And today we're going to focus on the banking and financial services industry. Steve, you are a longtime member of Emerald. You're the leader of our financial services research team. Why don't you tell us a little bit about your background and kind of what your focus areas are and maybe how you go about doing your job on a daily basis?
Sure. So I've been working with our Chief Investment Officer, Ken Mertz, on our Banking and Financial Services Fund for over 20 years. And one of the things that the team here at Emerald's always focused on is our fundamental research. Mm-hmm. And, I've come to learn that the more meetings we can have, the more we can get out on the road, the more we can learn, the more value we can bring to our investors. So for us, it's really getting out there, getting those meetings done, digging down deep, coming up with our own price targets and doing our financial reviews on our own and things of that sort. And I really think that's what adds a lot of value to our process here. That 10-step research process is something that we always harp on, and that's because it works.
Yeah, well, I couldn't agree with you more. And you probably spend as much time on the road as anybody on our team, trying to cover as much of the country as you can to see what's going on in a lot of these local markets. Now, I know you've been on the road a good bit in the last few weeks. Yeah. There's been a little bit going on in the world, a little bit of market turmoil. Some might call it market chaos. A lot of up and down, a lot of uncertainty out there.
Job never gets boring.
Never does. But I'm kind of curious with all of this that's going on, what are banks saying? Are they getting concerned out there? And what are you hearing?
It's really interesting because we started off the year with a lot of optimism. Management teams were looking forward to getting back to better earnings growth. We were talking about loan growth. Mm-hmm. We were talking about the economy having a soft landing, and things were looking great, and we were really optimistic. When we looked at fourth quarter, we saw a lot of loan originations. Now, a lot of those were commercial and industrial loans, and the companies weren't necessarily drawing down on the lines yet, but they were looking to get those lines in place so they could fund their growth in the second half of the year. Now the question is whether or not we're going to have that growth in the second half of the year. So there's a lot of uncertainty out there with bankers. So the bankers still feel great about credit quality. They've been able to get cost of deposits down, so they feel very good about that. That'll help with growing earnings as they bring those deposit costs down. But the question is where we're going to go on growth this year. Does the economy slow? Does the economy stay, kind of stagnant for a while here? And so that leaves a lot of uncertainty, and that's kind of where bankers are now. Credit quality is good. It's just a matter of, are we going to get that growth? And that's the unknown right now. And getting the update from the bankers, they really don't know yet. They're talking to their clients, and they say, our customers, they feel confident, they feel good about things. But that uncertainty that's out there around tariffs and everything else with the economy and unemployment and things of that sort, that's one of the things they kind of want to just put things on pause until they kind of get a clearer picture, I think.
So this isn't like some of the recessionary environments that we've seen in the past. You've been doing this for quite a while, where we went into these where bank balance sheets were a little overextended, a little bit shaky. From what you're saying, that doesn't seem to be the case right now.
No, the banks have done a great job on making sure they have enough capital, enough liquidity, and like I said, credit quality's held up very well. And I really think it's just people are kind of frozen in place right now, waiting to see what happens. Is this a longer term thing with tariffs, or is this a negotiation? How quick does the negotiation happen? Mm-hmm. And what's the effect of it on the economy?
Yeah. Several months back, we had seen the Fed lower rates for us a little bit, but market rates stayed kind of stubbornly high.
Right.
That's been changing here in the last several weeks, where rates have come down quite a bit. Might be careful what you wish for, but mortgage rates also starting to inch down a little bit. Yeah. Good or bad for banks? What do you think?
Yeah. So we have seen mortgage rates come down. Mortgage rates came down about 11 basis points over the last month or so. We're right around 6.7% for a 30-year fixed mortgage, and we really need to get down closer to 6% before I think we start seeing more activity on the home buying side. So it's been a slower spring home buying market. But the lower rates, I mentioned before, cost of deposits coming down, the banks have done a much better job than they have historically. When we see cost of deposit, or we see interest rates go down, deposit pricing doesn't go down as fast. The banks were pretty quick on moving on deposit costs as we started coming down in rates. So that's helped out. We're still seeing some of the loan portfolios actually re-rate up, because typically a community bank, they're doing 5-year loans, or the loan reprices in 5 years. So you're seeing some of those old loans repricing still at higher rates. But the question's going to be, where do we go from here? Do we continue? If we see rates come down, it's actually better for banks if they come down at a slower pace. So the next FOMC meeting, I think, is May 6th or 7th, May 6th and 7th. And so we have about another month. We'll see what happens there. But, if we can kind of stair-step down in rates, that'll be positive for banks, because they'll be able to reduce their deposits. They'll still see some upside on the yield on the overall loan portfolio. So I think that's an environment that's actually perfect for banks. If you have a slower but reduced kind of rate environment, I think the banks can adjust their balance sheets appropriately. And I think it'll be better. It also takes some pressure off of commercial real estate. So a lot of people have been concerned about commercial real estate as rates were going up, and how those loans reprice. And as those rates come down, that'll be positive. And also it'll be positive for some of the marks, unrealized marks within their securities portfolios as well.
One of the other big drivers of bank stock performance over time has been merger and acquisition activity, as we've seen the industry consolidate. Started to see some of that activity coming back in the last few months. What does this whole market environment do to that?
Right. So we had started to see some of the M&A activity come back, and over the last week we just had a couple of deals announced. I think a lot of that, one's driven by, we're seeing deals close at a quicker pace. The regulatory environment seems to be a little more friendly to getting deals done. But one of the things that we are concerned about is, with the pullback in the market, if you start seeing some of the multiples come down on some of the acquirers, so the banks that are actually acquiring other banks, they're doing it on a stock deals. They're not doing cash acquisitions, so they're doing stock deals. And so they need that multiple for the deals to make sense, for the tangible book value dilution, and I'm getting a little technical there, but basically the earn back on the investment, it makes the math work better for the acquiring bank if they have a better multiple. And so we don't want to see those multiples go down too low, because that'll slow some of the acquisition activity that's out there. But overall, all in all, we think there's still plenty of talk that's going on. We still think, if not in the first half of the year, the second half of the year, we'll see M&A activity pick up. And we're pretty optimistic about that. And we definitely think so as we move into 2026 as well, that we'll continue to see that M&A activity continue.
When you're looking at a stock in the banking industry, is that something you're looking for, an acquisition candidate? Or how do you think about that?
So it's kind of funny, because sometimes you have bank investors that are looking at banks and they say, I think this is going to be a bank that's going to get acquired. They got an old C-suite, so the CEO is close to retirement. There doesn't seem to be an heir apparent there. But it's hard to play that game in the market. So for us, we tend to focus on growth-oriented banks with great fundamentals. They tend to end up being more of the acquirers than the banks getting acquired. But I certainly think, as you look at kind of the mid-sized banks now, some of the larger regional banks, as we're seeing the regulatory environment thaw and become more friendly, I think that provides an opportunity for some of our larger community banks to be acquisition targets from some of the larger regionals. So I think we, by default, by investing in good banks, will actually invest in some of those targeted banks as we start to see some of the larger regionals become more active on the M&A front.
Okay, so you talk about focusing on some of the stronger, faster growing, fundamentally stronger banks. So what are some of the maybe secular interesting themes that you're seeing out there in the banking industry that some of these banks are positioning themselves behind? Like, what would be an example?
Yeah, so one of the places that we've been interested in, and it's had its puts and takes in the market, and part of that was because of some of the regulatory things that we've seen, is with banking as a service. So banking as a service, that's basically when banks are providing the banking service for fintechs. So there's a lot of fintechs that want to provide bank-like services, whether it has to do with payments, whether it has to do with lending, offering credit cards. They want to provide that to their customers because they want to try to create a super app where you have your app and you can do everything from one fintech platform or one app. But they don't want to have the regulation of a bank. And they certainly aren't set up for that regulatory environment. So the banks step in and provide that and really take very little risk. If they're providing any lending services, they take very little risk with that lending. A lot of the banking as a service banks are actually covered by the fintechs for any potential losses, whether it's fraudulent or poor credit quality. So we think it's an attractive space. It's a very large fee-driven space, and it's a great source of cheap deposits. So we like that space, and we really like it now that the regulatory environment is a lot more clear now. There's always some bad players. I shouldn't say bad players. Some banks that didn't have the regulatory environment that they should have within their bank. Those banks have been kind of put on the sideline. There's clear quality banks in that space that have been doing it for years. And I think those are the winners, and that's one of the spaces we've been playing, and we will continue to play.
Definitely more of a secular theme than a cyclical theme in the industry.
Yes.
Yeah. Terrific. Steve, I want to thank you for being here today as our first guest here on Small Talk. It's been a fascinating conversation and certainly a very interesting time in the bank industry.
It is. And Digby says, though, keep digging deep. Look
Yes,
for great opportunities in the market.
All right. Great. I want to thank you to our audience as well. And we'll be back here regularly featuring insights and observations from other members of our research team. Thank you, everybody.